Trump's tax law, a mixed blessing for the U.S. economy. Highlights: rising Treasury yields amid fiscal challenges. Tax reform expected to cut revenues by $4.5 trillion over 10 years. Anticipated uptick in corporate earnings and stock prices. In the heart of the financial battlegrounds, President Donald Trump's sweeping tax cut and expenditure plan has just been given the green light by Congress. As a result, a potential U.S. government default has been narrowly averted, but at the cost of worsening the nation's long-term debt scenario. The Republican-dominated House of Representatives has sanctioned the extension of the 2017 tax cuts, including increased allocations for border security and defense. Meanwhile, it proposes steep reductions in Medicare and Medicaid expenditures, ultimately contributing trillions to the national debt. Trump, expected to affix his signature to the bill soon, believes it will serve as a powerful stimulus to the economy. But here's where it gets controversial. This legislation raises the U.S. debt ceiling by a substantial $5 trillion, delaying the X-date, the date by which the Treasury could no longer honor its commitments without raising or suspending the debt ceiling. Analysts had initially forecasted that this crucial moment could occur by late summer. Looking ahead, however, many experts fear the bill spells trouble for both the U.S. bond market and the country's fiscal stability. Nonpartisan analysts project an increase of $3.4 trillion in national debt over the next 10 years. This situation leads to two primary concerns: an oversupply of bonds and a dwindling appetite for U.S. treasuries, critical components that have fueled financial markets lately. Boldly stated by BlackRock, the rising U.S. government debt could jeopardize the special status of the U.S. in global markets. They caution that the reduced demand for the $500 billion in debt the U.S. issues weekly could cause borrowing costs to skyrocket. The new tax law's revenue reductions are estimated to total $4.5 trillion, with a spending cut of $1.2 trillion. Additionally, it could result in 10.9 million people losing their federal health insurance in the next decade. Yet, this reform aims to stimulate the economy by allowing companies to fully deduct costs associated with equipment purchases, research, and development. This in turn offers various tax incentives. But this is the part most people miss. Some investors are concerned that the persistent national debt could dampen the economic stimulus envisioned by Trump's One Big Beautiful Bill. According to Campy Goodman, a fixed income portfolio manager, the bill might enhance economic growth by up to 0.5% next year. However, he believes the markets are not fully appreciating the looming danger of escalating borrowing costs. Ellen Hazen from FL Putnam highlights that while the bill may accelerate corporate earnings, it could also result in prolonged higher treasury rates, making certain fixed income investments less appealing in the long run. On Wednesday, benchmark 10-year treasury yields climbed after a period of decline, signaling that fiscal anxieties are pushing investors to recalibrate their strategies. Andrew Brenner observes that certain bond vigilantes are starting to react to what they perceive as inadequate fiscal adjustments. Why is this important? By raising the federal debt limit, the bill averts the potential of a U.S. debt default, an event that could have disastrous consequences for global markets. Though many feel the bond market's reaction to the bill has been relatively calm, a consequence of anticipated deficits factored in with Trump's foreseeable return to the White House, other market forces like economic growth remain the focal point. At the same time, data indicating a potential slowdown has intensified expectations of interest rate cuts by the Federal Reserve. What do you think about the Trump tax bill's long-term strategy? Will it lead toward less economic surge or ultimately rattle the foundations of the U.S. economy? Leave your thoughts in the comments.